491. Which of the following statements regarding trusts and real estate investment trusts, REITs, is false? And the answer is 2. Income earned by a family trust is taxed at the tax rate of the youngest beneficiary. No, has nothing to do with the youngest beneficiary. All these other things are true. 1, beneficial owners are liable only for the amount committed to the purchase of the trust units. So you're only liable for how much you've paid. 3, family trusts allow a parent to deposit assets with a trustee and distribute the income to other members of the family. And that also is true. Parents can deposit assets with the trustee and distribute income to other members of the family. Yep, that's true. And then 4, mortgage trusts and equity trusts are 2 types of REITs. Real estate and investment trust. Mortgage trust and equity trust. Yes, they are 2 types, but this one's false, where you tax the income earned by a family trust is taxed at the tax rate of the youngest beneficiary. No. 508. Current assets on the financial statements of a business include 2, rents receivable. Current assets on the financial statement of a business include rents receivable, not rents payable, because remember in the other question, because that would be a liability. But assets, that would be rents receivable. Yes. Page 11. Question 531. Which of the following is not a depreciable asset? And the answer is 2. 50 acres of fallow land. That is, 50 acres of fallow land is not a depreciable asset. And why not? Well, it's because land does not really depreciate, at least in Lower Mainland here. Okay, 570. Which of the following is false with respect to the proprietorship form of business? And the answer is 3. The proprietor is liable for all debts of his business to the extent of his/her capital investment in the business only. No, you're not liable for all debts of your business to the extent of your capital investment in the business only. No, no, no. All right, that is false. So that's the answer. Now, the true things are: 1, a proprietorship is terminated upon the death of the owner. Yes. 2, a proprietor must pay tax on his or her business income at personal tax rates. Yes. And 4, there is no legal separation of the assets of the business and the other assets of its owner. And that is also true. But the thing that's false is that 3, the proprietor is liable for all debts of his business to the extent of his capital investment in the business only. 585. Which of the following is a liability on a financial statement? 585, and the answer is 2, mortgages payable. Which of the following is a liability on a financial statement? And 2, mortgages payable. That's a liability. 586. Which of the following is inconsistent with generally accepted accounting principles, GAAP? And the answer is 2. Assets are revalued upwards to account for the effect of inflation. No, we do not revalue assets upwards to account for the effect of inflation. We don't. That's inconsistent. But the consistent things, which are true, according to the GAAP, are: 1, expenses are recognized at the time they are accrued. And 3, fiscal year ends cannot be changed at will. Yes, that's also true. And 4, revenues are recognized at the time they are earned. So you recognize the revenues when they're earned, and you recognize expenses when they're incurred. So those are all true, but the untrue thing is 2, assets are revalued upwards to account for the effect of inflation. No, there's no help on inflation here. And we got page 12 here. 625. In a limited partnership, there must be 4, there must be one or more general partners. In a limited partnership, 4, there must be one or more general partners. Question 643. Which of the following is not a commonly used financial statement? 643. And it is for a corporate statement of holdings. Corporate statement of holdings is not a commonly used financial statement, okay? It's not. Corporate statement of holdings. The other things are common. A statement of profit and loss, an income statement, and balance sheet. Those are all common, but not a corporate statement of holdings. 654. Which of the following is a liability on a financial statement? And the answer is 4, none of the above. So none of these things are liabilities on a financial statement. 1, accumulated depreciation. No. 2, inventory. And 3, rents receivable. Those are all not liabilities. 13. Page 13, question 660. When referring to the assets portion of a balance sheet, the items are generally listed in order of liquidity. Which of the following correctly lists assets from most liquid to least liquid? And the answer is 2. Marketable securities, accounts receivable, inventories, and prepaid expenses. So these assets are the most liquid to least liquid. You got that? So we got 2, marketable securities, accounts receivable, inventories, and prepaid expenses. These are from most liquid to least liquid, the assets portion of a balance sheet. Question 676. Depreciation expense is 4, none of the above. None of the above. 4, none of the above. Which includes 1, another name for capital cost allowance. 2, a deductible expense in computing income for purposes of income taxation. And 3, usually calculated on land by the straight line method. Okay? And then 4, none of the above. So the answer is all these things. There's none of the above. 710. Relax Realty has ended the current year with a net income of $234,000. During the year, Relax has issued $14,000 in dividends, including $1,112 of operating expenses, and paid $15,000 in taxes. Alrighty then. Which of the following most likely occurred on Relax's balance sheet? So let me get this straight. They've got net income of $234,000. They've issued $14,000 in dividends, $114,000 in operating expenses, which comes out to, let's see, $126, and paid $15,000. So $126 plus 15 is $136, $141. So we got $141,000. All right, so 710, 4. The answer is 4. Retained earnings increased by $220,000. So we've got retained earnings increased by $220,000. You got that? Alrighty then. So we're going to figure that out later. And we've got page 14, question 715. Yuppie is the sole proprietor of the Mountain Bike Emporium. On her balance sheet as at December 31st, 2000 whatever, total assets were $185,900. If the only liabilities were accounts payable of $2,900 and long-term debt of $89,450, what is the amount of owner's equity Ms. Yuppie capital account? And the answer is 1, $93,550. And as far as I know, this would be taking the liabilities, accounts payable of $2,900 and the long-term And the long-term debt, of 89,450, adding them up, and you get the answer, which is number one, 93,550. You got that? Question 716. Which of the following statements regarding generally accepted accounting principles is false? And the answer is 3. Assets are recorded at fair market value when they are acquired. No, we do not do that. We don't record the assets at fair market value when they are acquired, okay? But all these other things are true. 1, revenues are recognized at the time they are earned. 2, fiscal year ends cannot be changed at will. And 4, expenses are recognized at the time they are incurred. Yes, all these things, but the false thing is 3, assets are recorded at fair market value when they are acquired. That is totally, blatantly, unequivocally false. 737. Current assets on the financial statements of a business include 3, marketable securities. So marketable securities are current assets on the financial statements of a business. 740. Depreciation expense is 2, an accounting concept which attempts to allocate the cost of an asset over the life of an asset. So depreciation expense is 2, an accounting concept which attempts to allocate the cost of an asset over the life of an asset. You get that? So we got page 15, question 785. Which of the following is not a characteristic of a corporation? And the answer is 3. The shares of a corporation must be held by more than one party. This is not a characteristic of a corporation. 3. The shares of a corporation must be held by more than one party. That is not a characteristic. But all the other things are characteristics of a corporation. 1, a corporation can be sued. 2, the shareholders of a corporation cannot be held responsible for more than their agreed share of purchases. Yes. And 4, a corporation is a taxable entity. Yes. But this thing, which is 3, the shares of a corporation must be held by more than one party. No, that's not necessarily so. 821. The shareholder of a corporation may, number 4, 2, 3, but not 1. The answer is 4. 2 and 3, but not 1. So what is 2? That is vote to shareholder of a corporation may 2, vote to elect the board of directors of the corporation. That is true. Number 3, receive taxable dividend payments. That is also true. Okay, but not 1. Terminate the existence of the corporation by selling her shares. No. So let's get this straight. The answer is 4 about the shareholder of a corporation. 2 and 3 are correct. 2, vote to elect the board of directors of the corporation. 3, receive taxable dividend payments, but not 1. Terminate the existence of the corporation by selling her shares. No, can't happen. 833. Fannie Mac Limited purchased a small commercial building for $225,000, of which $100,000 was the value of the land. Fannie, the company president, felt this was an excellent deal because she would be willing to pay as much as $250,000. 1 year later, Fannie sold the property for $300,000. Woo! If at the time of purchase the expected economic life of the building was 10 years, there was an estimated salvage value of $25,000 at the end of that time. And Fannie uses the straight line depreciation method. What is the depreciation expense for the year? Alrighty then. So the depreciation expense for the year for 833 is number 1, $10,000. Okay, so $10,000. So that is the straight line depreciation for the year. And I'm going to have to check that out later when I get a chance. So page 16, 834. Freddie Mae Limited purchased a small commercial building for $225,000, of which $100,000 was the value of the land. Freddie, the company president, felt this was an excellent deal because he would be willing to pay as much as $250,000. 1 year later, Freddie sold the property for $300,000. According to generally accepted accounting principles at the time of purchase, the value of the building in the question above should be recorded on Freddie May's balance sheet. Okay, and the answer to 835 is 125,000. So 125,000 is the value of the building. Okay. So let me see the value of the building. So we're also going to have to take a look at this because I'm trying not to do calculations in my recordings because it's kind of like quite difficult to listen to calculations over in a recording. So 843, which of the following statements regarding capital cost allowance, CCA, is false? And the answer is 3. The maximum CCA in a given year is equal to the depreciation expense multiplied by the CCA percentage. That is totally wrong. This is wrong. False. 3. The maximum CCA in a given year is equal to the depreciation expense multiplied by the CCA percentage. But these other things are true. 1. Only 1/2 of the maximum allowable CCA may be claimed on an asset in the year the asset is purchased. Only half in the year you buy your asset. 3. No CCA may be claimed in the year of the asset's disposal. That's also true. When you dispose of your asset, you can't claim CCA. And 4, the CCA percentage rate is determined by the Canada Revenue Agency. Absolutely true. But the false thing is 3, the maximum CCA in a given year is equal to the depreciation expense multiplied by the CCA percentage. Totally false. 858, consider an asset with a purchase price of $185,000, economic life of 9 years, and $5,000 salvage value. If you purchase the asset today, what will be its book value in 3 years? And the answer is, drumroll please, 1. The answer is 1, 125,000 smackaroonies. So we got page 17, 881. A company pays $97,835 for an asset on which the Income Tax Act allows capital cost allowance at 5% per year. The asset is expected to have a useful life of 25 years and will have no salvage value at the end of this time. Calculate the depreciation expense for accounting principles for the asset's 3rd year if the accountant uses the straight line of depreciation. And the answer to 881 is number 1. $3,913.40. So the answer is the answer is 1. Okay, and we will calculate that later. 893. The principle of unlimited liability implies that 3. An owner may lose more money than his or her initial investment. This is the principle of unlimited liability. 3. An owner may lose more money than his or her initial investment. So you shouldn't do the unlimited liability. I don't see what's the advantage of it. I don't know why anybody would do that. 901. In the case of a proprietorship, which one of the following accounts represents the link between the income statement and the balance sheet? So, where do you put the link between the income statement and the balance sheet? So which account is the link? The answer to 901 is number 1, net income. All right, so net income, that is the account which is the link between the income statement and the balance sheet. Net income, get that. 904. A company has just bought a truck for $22,500. It's expected that the truck cannot it can, yes it can, be sold for $3,000 15 years from now. The current market value of the vehicle is $27,000. Using the straight line method, what is the annual depreciation expense? And we shall get this later on when I calculate it, but now I'll give you the answer. It's 1, which is 1,300. 1,300. And my last page, 18. Question 912. The subject clauses have just been removed from the contract of purchase and sale, but the sale will not complete for another 17 days. Sandy salesperson has already recorded the commission from the sale as income. Which of the generally accepted accounting principles was she following? And the answer is 4, the revenue recognition principle. I'll read this question again. The subject clauses have just been removed from a contract of purchase and sale, but the sale will not complete for another 17 days. Sally salesperson has already recorded the commission from the sale as income. Which of the generally accepted accounting principles was she following? And it's number 4, the revenue recognition principle. Okay? The revenue recognition. So this basically, you record revenue as it's earned, not as when it's paid. 970. Arco Architects recently purchased $19,000 worth of new office furniture. But with their quantity discount, the final cost was only $17,100. It's expected that the furniture can be sold at the end of 10-year life for $1,500. What is the annual depreciation expense if Arco uses the straight line method? And our answer, and we'll calculate this later, is 2. 1,560. That is the answer. 1,560. 995. A company pays $97,635 for an asset on which the Income Tax Act allows capital cost allowance at 5% per year. The asset is expected to have a useful life of 25 years and will have no salvage value at the end of this time. Calculate the depreciation expense for accounting purposes for the asset's third year if the accountant uses the straight line depreciation method. And the answer for 995 is 4. $3,905.40. So 3,905.40. And there you go. That's all we will do for this moment, my friends. This is Chapter 8, Lesson 5, Financial Statements. Have yourself.